How many income streams are you, your friends, and family aware of? How many income sources do you currently take advantage of? Rich people don't just have one income source like many of the working class. They don't limit their income earning to just when they're clocked in at their 9 to 5, trading their time for money for days on end. In fact, the average millionaire has 7 different income sources. How do rich people earn income in 7 or more ways? Earned income is how most people make their money, but there are many other income-generating possibilities to take advantage of. There is much more to earning money than what most people are aware of. In order to become financially independent, you must have money work for you, instead of only working for money. If you enjoy videos about money, personal finance, and investing, all topics that will help you better your financial future, consider subscribing to the channel and hit the notification icon to be notified of new videos. If this video is helpful, make sure to hit the like button. Earned income. By far the most common type of income, and the kind that everyone knows about, earned income is that received from working, such as a job for a paycheck. This is when you're compensated based on the work that you do. Many workers are paid hourly, and their compensation is directly correlated with the amount of time spent working for someone else. It can also be when an individual is self-employed, and they work on an hourly basis, or get paid per task, or even commission-based. In all of these circumstances, the money must be worked for to get paid, and stops coming in as the working stops. Earned income is usually taxed at a higher rate, due to the fact that there are fewer tax deductions available. Many of us have heard the acronym for JOB, just over broke. People are sometimes unable to see opportunities beyond working income, believing the myth that a job is stable and secure and allows you to stay in your comfort zone with very little risk. While that might not be something to disagree with, the risk lies within relying solely on that income source and not diversifying into other streams of income. The actual risk of a single source of income, often from an employer, is a very real risk indeed. Profit income. Profit income is money earned from selling something for more than what it costs to make or purchase. When a grocery store sells items for more than it costs to purchase something, they're earning money from profit. A car dealer earns their money when they sell cars for more than they purchased them for, and earning profit on the loans and maintenance services they offer. Earning this type of income takes a decent amount of work to begin, as it typically requires the startup of a business. But you don't necessarily need to create the next Walmart or Amazon to earn some money in this way. A salesman could go door to door selling a cleaning product for more than he purchases the product for, which would require very minimal startup costs and overhead. People working for earned income often have a difficult time earning income like this because it requires some degree of courage in terms of invested time and capital to begin. Also, it may require an uncomfortable amount of time away from the earned income job in order to begin a new venture. To be an entrepreneur and rake in the profits, you need to choose a product or even a service that you want to sell, perhaps something that draws on personal passion. This could be cars, clothing, or even opening a restaurant. By presenting the product well and treating your customers well, income through profit can be financially very rewarding. Interest income. Earning interest is as simple as lending your money to someone for a charge. The interest received by lending will depend on how long the money is lent for and what the money will be used for. For example, if you were lending money to an investor who is using the money to flip a house in a short amount of time, the interest rate will be much higher than if you're lending it for the purchase of a rental property, which will be held for a long period of time. Rental properties are usually held for a long time, usually years, while buying homes to fix up and sell happens very quickly. Although the total interest earned might be similar, the terms can be vastly different. Interest income could mean lending your money to an individual who's going to start their own business, lending it to someone who wants to buy themselves a new car, or simply putting the money in a bank account or lending it to the government in the form of treasury bills. A payday loan company earns money by lending to individuals based on the agreement that the borrower is going to repay the loan upon receiving their next paycheck. This is one form of income that can be completely passive once arranged, not requiring any effort other than that spent acquiring the money to begin. However, the amount you're able to earn is limited to the amount available to lend, in the amount the borrower deems fair to pay in interest charges. Dividend income. Dividend income consists of payments shareholders receive for simply owning a dividend-paying stock, such as 3M, Coca-Cola, Walmart, or Johnson & Johnson. If you own an index of the S&P 500, for example, you'll receive approximately 2% of your holdings' value in the form of dividend payments, which are usually paid out quarterly. Individuals with a sizable amount invested can often achieve financial independence by living solely off these dividend payments, allowing the rich to get richer, so to speak. In other words, the principal of the investments increase while investors receive some cash flow. Many retirees choose to live off their dividend payments, provided they have enough invested to fund their monthly expenses. Think of dividend income as cash flow from a rental property. The property has the potential to appreciate while still providing cash flow. Rental income. This type of income is money most commonly received for renting out property. Usually, houses or apartments are rented to tenants in exchange for a monthly sum, but the real estate could consist of industrial spaces, warehouses, storage trailers, and even land. Spaces at shopping centers are likely rentals that are paid for on a monthly basis. Many of those retail stores prefer to rent space instead of purchasing and managing their own properties, which allows them to spend more time on their products and services instead of dealing with maintenance, repairs, extra bookkeeping, and other property management tasks. There are many different types of assets that generate rental income, not just the single-family homes and apartment buildings that are most commonly thought of. People rent boats, campers, cars, tools, and the list is virtually endless. Pretty much every type of real estate can also be used to generate this type of income. In order to earn profit from rental income, the money received needs to pay the expenses of the property or item and hopefully provide money left over, which is known as cash flow. Capital gains. This type of income is received from the sale of an asset that is increased in value. A home that is increased in value, a stock's appreciation, or an antique car that was purchased for $10,000 and sold for $20,000 are all examples of this. Capital gains income is most commonly received from stocks or real estate, but there are unlimited opportunities to earn money in this way. However, unlike other types of income, the gains can only be realized when the item is sold for a profit. For example, if you own a stock that has doubled in value, the only way to take that money is to sell the stock. The amount one can potentially earn from capital gains is limited to how many assets they can buy and sell, somewhat limiting the passivity. Royalty income. Money received for intellectual property is known as royalty income. This is most commonly in the form of copyrighted material, such as a song or a book. There are other types as well, like artwork in the form of logos, designs, slogans, or patents. This type of income, once created, can produce a passive income stream for years for the original artist or inventor, for as long as the material remains protected under the law. If you have intellectual property that you want to receive royalties from, there are two ways to do this. You could sell the property and receive payments from the buyer based on a percentage of the revenue generated from that property. For example, you can sell the copyright to a book outright and receive royalties up front and receive a continuing stream of revenue based on the sales of the book. Secondly, you may keep the ownership of the property and get royalties from someone for the use of the property. This is called licensing. Royalty fees and payment amounts can be set in a variety of ways. In a franchise situation like a fast food restaurant, fees can be set as a fixed or variable percentage of gross sales. In many cases, there is a minimum royalty. Royalties are another great source of income for someone who produces a product or service and cashes in on that intellectual property. If you want to earn more money, it's imperative to not limit yourself to solely earned income. Adding more income sources to your life will allow you to start earning passive income, money while you sleep, to eventually limit the number of hours spent working a job, being stuck in the rat race, trading time for money. There are only so many hours that can be spent working for earned income, so start earning money the way the wealthy do, with these other income opportunities. Passive income is an ideal way to bring in some extra money while you're focusing on other important things. Passive income can be generated while you're at work, while you're on vacation, or it could just be how you fund your retirement lifestyle. Income being made while you're not actively working for it can allow you to pay your bills so you can retire. Some believe that passive income only comes through simple, common, and traditional sources, but there are many creative ways to make some extra money that you might not think of. These are some ways that you can easily generate at least $500 per month passively. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. It's important to remember that passive income doesn't mean no effort is required to begin earning. Everything takes some amount of upfront work or money in order to start and usually requires some additional time on occasion. The good news is that this typically involves more managerial tasks as opposed to active work. Rather than thinking of passive income as money coming in for doing absolutely nothing, consider it money being made with very little effort so most of your time can be spent doing something else. With the cost of housing always increasing, there's more demand for rentals by the room. For a single person, a private home can be too expensive and simply a waste of money when they can live with a roommate. If you have an extra bedroom in your house or apartment, this can be an easy way to make money for doing close to nothing. Since housing is the single largest expense of the average household, this is also an excellent way to lower that expense. Just renting out one bedroom could bring in $500 to $1,000 per month. While living with a friend, family member, or even a stranger isn't ideal for everyone, it does have some benefits, such as additional security. Some people even take this method of house hacking to the next level by purchasing a large home with many bedrooms. Renting all of the bedrooms can far exceed the cost of owning and maintaining the home. Many people live in an apartment, condo, or in a home with limited parking and need somewhere to keep a vehicle. If you have extra space at your home, you could rent it out to those who need it for a sizable amount of money. Depending on where you live, you could charge $50 to $200 or even more per month for a single parking space. This idea doesn't have to be limited to just parking either. You can rent a storage shed, garage space, or an unfinished basement to someone who needs some extra storage. Neighbor is an app like Airbnb that will allow you to rent these types of places with very little work. You can also go a more traditional route and rent by word of mouth or with other forms of advertisement. This is an excellent way to generate income from your home with very little work, and it doesn't require you to live with a roommate who won't wash their dirty dishes. Investing in the stock market is perhaps the most common method that comes to mind when people hear passive income. There are multiple reasons for this, including the fact that it takes little to no time and doesn't require any expertise. Once set up, it will continue to reward you with almost no management for a very long time. The S&P 500 averages about a 10% return every year. By investing about $60,000 in an S&P 500 ETF, such as Vanguard's VOO, you could expect to earn $500 per month on average. This dollar return will also increase each year as your investment principal grows. Furthermore, unlike other passive income ideas, this provides you the ability to earn compound interest. Each year, your stock investments will generate exponentially higher returns. The downside is that not everyone has $60,000 to begin with, and it can take quite a bit of time to grow a beginner's portfolio to a size that will produce $500 or more on an average month. The previous example of investing in an S&P 500 ETF is a great way to generate passive income, but some people prefer to separate capital gains and consider just the dividends as the passive income they'll receive. They'll ignore the rising stock prices and only count the dividends received as their passive income. The S&P 500 has an average return including dividends of about 10%, with the dividend portion making up about 1.5% of that total. In order to generate $500 per month in dividends alone with an S&P 500 ETF, you'd need a whopping $400,000 invested. By investing in a high dividend fund, you could reasonably assume a 4% dividend yield, meaning you'd need $150,000 invested to receive $500 per month in income. Furthermore, the principal of your investment will likely rise over time, like with the S&P 500 fund, just at a lower rate.
Investing in a rental property has the potential to provide huge returns, and that's primarily because returns come in several forms and aren't just limited to one form. Cash flow is received when the rent exceeds the cost of owning the property. Simply put, if the owner's expenses are $2,000 per month and the rent received totals $2,500, your cash flow is $500. If you have a mortgage on the property, the balance is paid down each month. A $300,000 loan for 30 years will be paid down an average of $833 per month, less towards the beginning of the loan and more towards the end. Additionally, the property will usually appreciate in value. You could reasonably assume a $400,000 property would appreciate 3% or $12,000 per year. Being a landlord does require some work, even if you plan on hiring a property manager, but it still requires much less effort than a typical job. There are many people who have excellent ideas for a new business but lack the funds to get started. Perhaps you have a friend or family member with an excellent opportunity, they just need some capital to get their business off the ground. You could act as a private lender and invest in their idea and charge them an interest rate of 10 or 15%. This is very common, especially with real estate. A house flipper would approach a private money lender who is looking for a return on their money. The lender would finance the flip in exchange for interest payments. If you're worried about the likelihood of success for the project, it's common practice for the lender to have the right to the property in the event that the loan can't be repaid, similar to how a bank can foreclose on a property. There are also websites that allow individuals to easily lend money, such as Prosper and Upstart. You might have seen people driving around town with cars that are covered in a company's advertisement. The entire vehicle is probably wrapped in colorful logos and slogans. While it might appear that those people are employees of that business, they might just be driving their personal car and are on their way to work, school, or just doing errands. Some companies will pay a monthly fee to those that are willing to use their own car as a rolling billboard. How much you earn will depend on factors like how much you drive and where you're located, but this is a valid option to generate income. Instead of spending a lot of money commuting to work, you could actually be getting paid for this. Not all of these methods will be preferable for everyone. As with almost all passive income sources, they do require at least a little bit of money or effort. It's unreasonable to expect to receive passive income from doing absolutely nothing, and chances are there's no method that's extremely desirable. Meaning, there's no scenario where no money or time is required and money will just be deposited into your account like magic. There's no realistic scenario where you'll deposit $5,000, $10,000, or even $50,000 and earn enough income to retire. But these are some proven ways that an average person can make $500 or more per month if they're willing to set forth a little effort and drop the "this wouldn't work for me" mentality. Would a $1 million portfolio provide enough dividend income to retire? $1 million is a sizable amount of money, and it could even provide the money needed to receive a full-time income. It might be enough to fund your housing, transportation, travel, and all of your other living expenses, all while your capital continues to grow, setting you up for an even brighter future. The peace of mind that comes with seeing money deposited into your account when you're not working without the worry of market fluctuations can be reassuring. Getting paid to wait is hugely rewarding. Depending on what types of investments you own, you might be surprised at how much dividend income you would receive from $1 million. Watch to see how much cash flow that could produce and to find out how to maximize your profits. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. The amount of dividend income you will receive obviously depends on what types of investments you own, as they all provide varying dividend yields. Some investors buy a simple fund that holds the entire S&P 500. Some buy individual stocks that they've chosen because they think they will outperform, and some investors purchase a mixture of stocks and funds. Dividend yields will vary based on how aggressive your portfolio is, because growth stocks provide less income and more capital appreciation, while value stocks provide higher dividends and lower capital appreciation. Which you choose to buy should really depend on how long until you retire. Investing in just income and value stocks when you're young could leave money on the table, as their returns are generally lower than fast-growing companies. Dividend yields don't really matter to younger investors who are just trying to maximize returns. If you were to invest in the market or a fund that tracks the S&P 500, the dividend yield you would receive would be average because you're buying the market. Your overall returns from dividends and capital appreciation will be average. Although the S&P 500 holds many high-growth technology stocks, it also owns dividend and value stocks, which provide a combined dividend yield of around 1.5%. With $1 million invested in the S&P 500, that would mean about $15,000 per year in dividend income, or $1,250 per month. Dividends from most S&P 500 funds are paid each quarter, which would mean you receive $3,750 every 3 months. Even though the dividend yield is nothing special, the overall returns of the S&P 500 have averaged about 10% per year, meaning you have a nice balance of income and growth. Even if you were to spend all dividends received, you'd still become significantly wealthier year after year. In order to achieve a higher growth rate, you could invest in an S&P 500 growth fund, which holds the best growth stocks found within the index, companies like Apple, Microsoft, and Google, and little to no value stocks. This is ideal for people who won't be retiring for a long time, since the overall return will be higher than average, despite a lower than average dividend yield. Since most of the holdings are tech companies with little to no dividend, you'd only be getting around a 0.5% yield. With $1 million invested in this type of fund, you'd receive about $5,000 per year in income. That's only $415 per month or $1,250 per quarter, but keep in mind that growth will be substantial. Consider the recent returns of these fast-growing companies. In just the past year, Tesla, Nvidia, and other stocks have seen their prices skyrocket, which far outpaced most dividend stocks. The dividend yield is only about 1/3 of the S&P 500, meaning you'd need 3 times the amount of money invested to receive the same amount of income. However, since the growth is so much higher, you could reach that number much more quickly. If higher dividend income is something you need to live, or if you're retiring soon and don't mind a lower overall rate of return, you might consider buying a fund that's designed to specifically provide higher than average dividend income. A good example of this type of fund is SPDR's S&P 500 High Dividend ETF. This includes companies within the S&P 500 that have the highest dividend yields. These are stocks like Iron Mountain, Simon Property Group, and US Bancorp. These funds almost always experience slow capital appreciation because the companies held are focused on generating consistent profits and income for shareholders instead of trying to grow. This fund currently yields around 4.5%, meaning you'd receive a $45,000 annual paycheck or $3,750 per month with $1 million invested. Investments such as this are better for those who currently need retirement income and are no longer in the accumulation stage. Another good option for those who don't mind doing substantial research is to purchase individual dividend stocks. Commonly, investors search for healthy companies that have a history of dividend growth and that have growing profit and earnings. In simple terms, this means that the company's share price is likely to increase as well as increasing dividend payments. A dividend stock that has a 10% yield but loses 20% of its share price is not a good investment. Unfortunately, many novice investors fail to realize this and are lured in by high yields, even though many of them are a result of a declining share price. What they should research is why the dividend yield is unusually high and if the company will be profitable in the future. Individual stocks are the riskiest option, but they also have the most potential. Share prices are always fluctuating for various reasons, which means it's easier to find a deal. In one case, a company might have had some less than desirable news and the market overreacted, allowing you to buy at a discount. The problem with only investing in funds is that deals are much less common because the price of each stock is bundled into one price, meaning they rarely go on sale. AT&T has been one of the highest paying dividend stocks in the S&P 500 for quite a while. The telecom and media giant handsomely rewards shareholders with dividends instead of reinvesting for growth. With a dividend yield of around 7%, that means $70,000 per year in dividend income with $1 million. That's significantly higher than even the S&P 500 High Dividend Fund. However, the share price hasn't risen much over the past 25 years. Ideally, you receive a comfortable dividend yield and the share price rises over time. One thing to look for is a long period of rising earnings instead of flat or declining profits. You also want to watch for a consistent rise in revenue, which means their sales are increasing every year. These things, in addition to other important metrics, will help you select quality stocks. If individual stock picking is too risky and time-consuming, you could simply buy sector-specific funds. For each sector of the market, there are funds available. The energy sector has a higher than average dividend yield. If you think the energy sector is going to perform very well in the future, consider adding money to a fund like Vanguard's VDE, which will provide an almost 4% dividend yield. The amount of dividend income generated from a portfolio of this size can be pretty nice for doing nothing. On the low end, you'd be receiving about $400 per month, but a proper dividend portfolio should consistently generate almost $4,000 per month, all for just waiting. Considering the average Social Security benefit is almost $1,500 per month, many people would be comfortable living off this amount. Investors can adjust their portfolio to achieve the right combination of growth and income so they can maximize their returns and future income. Some simple calculations will help you determine if you should invest more heavily in growth or more heavily in income stocks depending on how long until you retire. Dividend investing has become increasingly popular among the financial independence retire early community, and for good reason. Cash flow can help pay your bills, but you need to ask yourself if you should invest in income investments, something that will track the overall market, or growth investments that tend to outperform the market. A broad market fund like the S&P 500 might provide the right balance of income and growth. Consider the amount of income you might expect to receive from these different types of investments and your time horizon. This will help you map out an investment strategy that isn't leaving money on the table in terms of lost growth.